Okay, so for today's video, I'm going to be going over what are fair value gaps. Now, this is the second video of this current playlist that I'm making. The last video was over liquidity, so this is going to be correlated to that video. Fair value gaps are internal range liquidity. I went over that in the previous video. So right here, you've got your swing low, swing high. This is external range. Now, obviously, this is a bullish trend right here. Now, what you tend to find inside these trends are gaps in the market, which are called fair value gaps, imbalances. Okay, so I'm going to be going over how they form, how you can use these for entries, exits, daily bias, and investment opportunities. Okay, so what I have right here is a bullish trend and a bearish trend. Now, fair value gaps are formed from a 3-candle structure. So as you can see, we've got 3 candles right here, and there is a gap being left in between right here. As you can see, there is no wick invalidating this wick here, and there is a gap in the middle. Now, if this body was down here, as you can see, there is no gap. Same for if there was a wick, and the wick was here, and it came through, invalidating this wick, there is no gap. However, if the wick is here, then you're going to be drawing the gap from the high of this wick to the low of this wick. This is a bullish fair value gap. Now, essentially, what you're going to be looking for off bullish fair value gaps, buying opportunities. Now, these form on every single time frame, every single day. So now I'm going to be covering, now I've covered that, I'm going to be going over the bearish one, which is the exact same as this. However, you're going to be looking for the low of this candle to the high of this candle. And you're going to be looking for a body in between, creating a gap. Right, there's your bearish fair value gap. Here's your bullish fair value gap. So you're going to be looking for shorting opportunities off the bearish fair value gap, longing opportunities off the bullish fair value gap. And now there is one more fair value gap, which I'm just going to get over in a second. Okay, so as you can see here, I have the exact same thing as this. This is a bearish fair value gap. However, there are 2 bullish up close candles here, which is invalidating this bearish fair value gap, turning it into a bullish fair value gap. However, this is going to be called an inversion fair value gap. Now, the reason this has been inversed is we have a candle closure above it. So most people would be looking for shorting opportunities off of a bearish fair value gap. Now, as you can see, we've got a closure above this bearish fair value gap, turning it into a bullish entry point, and you would potentially be looking for longing opportunities, buying opportunities off of the closure, invalidating this fair value gap. So I'm just going to be drawing up the structure of how these fair value gaps will essentially be traded. So you've got your structure forming here. Here's our 3-candle structure. Now we want to pull back to this bullish fair value gap, and we'll be looking for buying opportunities to target higher time frame liquidity or just swing highs and swing lows in the market. So you would be looking for buys right here. So you'd be entering a longing contract, targeting your high, stop loss below the low, and that would be how you trade a bullish fair value gap. Now it's the same for a bearish fair value gap. You'll be having your structure here. Now we have our 3-candle pattern, retracement back inside the gap, and then you'll be looking for shorts to target another form of liquidity down here. Okay, so now I've gone over a bullish fair value gap, a bearish fair value gap, and an inversion fair value gap. I'm going to be showing some demonstrations in the market, how I have used these on all different time frames for bias, entries, and exits. Okay, so looking here on the daily chart on NASDAQ, this is the pair that I am currently trading. As you can see right here, we have our 3-candle pattern. 1, 2, and 3. The wicks not overlapping. Drawing this out to the right. For this fair value gap to be invalid would be the wick just coming below this wick here, or this wick coming above this wick here. Now you can see there's no gap in the middle. Once I remove this, here's your gap. So this is your bearish fair value gap. Essentially, this is on the daily time frame. So you're going to be looking for shorting opportunities off of this fair value gap. Now, as you can see, price has traded up into this fair value gap, and then we have had a sell-off. Now we have come to retest it again, and we've also swept this liquidity. And I went over this in a previous video. This liquidity here is resting inside a fair value gap, turning it into a intermediate term high. So this is an even stronger form of liquidity. we have our fair value gap, our intermediate term high, and as you can see, we've had a drastic move straight after sweeping this. Now seeing the closure on the daily, potentially next week I might be looking for this low to get taken out. As you can see, we've created our high, our low, our high, so I'm going to be anticipating a lower low to get formed off this daily fair value gap, and this is essentially how you use it to gather a bias. So this is a bearish fair value gap on the daily chart. Now for me to be looking for longing opportunities off of this fair value gap, I would simply be looking for a candle to form on Monday and close above this fair value gap, so I can look for longing opportunities on the Tuesday. Okay, so as you can see here, we've had our bullish candle, and this bullish candle has closed above this gap. Here's the high of the gap. Our candle right here has closed above this high, invalidating the fair value gap, turning it into an inversion fair value gap. Now most people will be looking to short off this fair value gap. However, once we get the candle closure above, it turns into a buying opportunity to potentially target this high here. And this is exactly how I trade it on the daily time frame, the 4-hour time frame, the hourly time frame, and the 30-minute time frame. I simply wait to see which fair value gaps are being respected, like this one currently being respected, so this is still a bearish fair value gap, and I wait for the ones that are being disrespected. So off this, I'm looking for selling opportunities. However, if come Tuesday, our Monday candle closes above this, then it is a valid longing opportunity. Okay, so here's another example. As you can see, we've got our downtrend here. No fair value gaps really being formed. We have one right here. From the low of this wick to the high of this wick, there's a body in between. The wicks aren't overcrossing like they are all down here, leaving behind our fair value gap. And right here we have another fair value gap in this current trend. Now, these are both bearish fair value gaps. However, what I was just talking about in the previous slide, as you can see here, this is currently being respected, so you're looking for selling opportunities off of this fair value gap. Now, prices come up and we've got our closure above right here. As you can see, this high of this wick, the body of this wick, has closed above the high of this fair value gap, invalidating it, turning it into a bullish inversion fair value gap. So you're potentially looking for longing opportunities now off this bearish fair value gap to send price higher. Now pairing up swing lows and swing highs with fair value gaps, you get really strong zones of liquidity. So right here we have a bullish fair value gap. So I'm just going to mark this out, and as you can see, we have our low inside this fair value gap. So this is going to be our intermediate term low. Now watch what happens once price takes out this low. We get our move higher. Price came back lower, took out the next intermediate term low, and left a wick inside. So now we still have a 4-hour intermediate term low. However, intraday, these wicks down here are currently protected lows. So you can be looking for buying opportunities off this fair value gap, as now we have seen a tap into our fair value gap and our sweep of liquidity. So I traded using this the other day. I traded from here. I found a buying opportunity right here after sweeping this intermediate term low on the 4-hour, and I found another opportunity for a trade after sweeping this second low down here. Okay, so now going into next week, the markets are currently closed right now. We have this intermediate term low on the 4-hour. So for next week, I will be looking for price to potentially take out this high up here, and then we can look for price to sell off to target this low. So once we take out this zone of liquidity up here, now we have a good opportunity to sell price lower to fill this fair value gap and take out this low down here. And this is exactly how I trade fair value gaps and liquidity. Okay, so now I'm just going to be going over a quick concept about these fair value gaps, which I find very useful. So right here we have our bullish fair value gap. The lower the fair value gap to the higher the fair value gap, we have a midpoint, which is 0.5 of the range. Now this is called consequent encroachment. So this is consequent encroachment of the fair value gap, the midpoint, and you can tend to see on all time frames a drastic move after filling consequent encroachment. How I trade consequent encroachment on the higher time frames is if we have price pushing through, so this leg created the fair value gap, now we're coming lower, we have just tapped into consequent encroachment, then you can expect to see your drastic move higher. However, if we start getting closures below consequent encroachment, now you can start anticipating a potential reversal through this fair value gap, closure below it, to find shorting opportunities for an inversion fair value gap. So I use consequent encroachment to anticipate whether the markets are going to keep respecting the fair value gap or end up inversing it. Now, I also use consequent encroachment as an entry point. If we have a big fair value gap left in the market and I want a better risk to reward, I will be entering off consequent encroachment of the fair value gap, stop loss below the low, and my higher time frame target. Okay, so right here, I have this in my journaling Discord. We have our fair value gap. Now, this left quite a big imbalance in the market. This was a lower time frame. This was on the 5 minute. And as you can see, I used consequent encroachment, the midpoint, as my entry, and I got a much better fill, and I was able to risk more due to my fill being lower. However, if I had have entered here, like most people do, at the start of the fair value gap, I would have been having to risk less, or risk the same amount, but my stop loss would have been higher. So using consequent encroachment is a very important thing, in my opinion. And this is how I teach fair value gaps, and this is how my students have been currently trading them, and it's been working really well for everyone. Okay, so right here, this was another trade that I took after getting a market structure shift, which I'll be going over in another video. And right down here is a higher time frame fair value gap. Price has come higher, targeted this fair value gap to send price lower to take out this one. Now, as you can see, I've entered off this normally. However, I should have been entering off consequent encroachment of this fair value gap, as it has left a big fair value gap. So the larger the fair value gap, I tend to enter off consequent encroachment for a better risk to reward. Now, as you can see with this trade that I took, price didn't fill consequent encroachment of this fair value gap right here. So if I had been waiting for this fair value gap to get, the consequent encroachment of this fair value gap to get filled, my trade would not have been valid, and I would have missed out on this trade. So that is the risk that you sort of have when trading consequent encroachment in these fair value gaps. So you need to pair it up with context, and you need to also pair it up with the current volume in the market. Now, if the market's moving very quick and it's respecting bullish order flow, so bullish fair value gaps, then you can tend to get into your trades just based off the open of the fair value gap rather than consequent encroachment, as price won't want to come that deep inside. Okay, so now I'm on the monthly time frame on Bitcoin, just to show this on a different pair and a different time frame how this works. As you can see, price has been coming into this fair value gap right here. Hopefully you guys notice where it is. This one right here, this high to this low, measuring our fair value gap, pulling it out to the right. There's our fair value gap. Now, if you look at this, where has the reaction come from? It's come from once price has tapped consequent encroachment. Now, this is perfect, and this would have been a potential buying opportunity for many people. Consequent encroachment of this monthly fair value gap got respected by this candle here. Now, once we've wicked all the way through this candle with this manipulation, and we've come higher and closed above consequent encroachment, this is a perfect buying opportunity for Bitcoin, and off this you could be targeting this high right here, and I guarantee you this will be a winning trade. If anyone got in off consequent encroachment of this fair value gap and targeted the high, I can more than guarantee we are going to take out this high soon. Again, right here, I've just gone over this fair value gap right here. We have the exact same thing here with this fair value gap, consequent encroachment being respected, and we've had our bullish move higher. Now, what do we have here? We have our bearish fair value gap. So this one doesn't have a wick, so we'll be measuring it from the low of this body to the high of this wick, pulling it out to the right. So as you can see here, price has traded straight through this, and with this closure here, closing above the high, the low of this, above the high of this fair value gap, has invalidated this bearish fair value gap, and it has turned it into an inversion fair value gap, just like that. So this would have been a longing opportunity right here in the market, and as you can see, you would have got a winning trade off this, targeting this high here, just off this fair value gap, And this is just to show that it works on crypto, it works on forex, it works on futures, it works on options, and it works on every single time frame. So looking at XAU USD now, we have this fair value gap right here, pulling out to the right. As you can see, we have our candle closure above this bearish fair value gap, which will have turned it into a potential bullish trading opportunity. However, once we've got our candle closure above, price has opened lower and it has continued the trend to the downside. So this is because there was no context. This was just a random fair value gap in the market. So you need to pair up these fair value gaps with many other confluences, many other concepts, which I will be going over in this playlist. So yeah, this is why this fair value gap turned into an inversion fair value gap and ended up still being disrespected and trading off to the downside. Okay, so just to simplify this is what we have gone over today. We have got our swing high, we have got our swing low, swing high, internal range liquidity, fair value gap right here. Now we have this low inside this fair value gap. If anyone can remember what this is called, it's called an intermediate term low, the low inside of a fair value gap. Now what happens when price comes to take out this low? We get a drastic move higher, and we could have potentially been targeting this swing high right here. Now it works the exact same way for bearish versions. So right here we've got our swing high, swing low, fair value gap, the wick inside the fair value gap, price came higher, took out this wick, and we got a drastic move lower to target this swing low. Okay, so I'm just going to be going over the terms and abbreviations for today's video, just so you guys don't get confused. So fair value gap, this is just a normal fair value gap that I've been going over. The inversion fair value gap is once the normal fair value gap gets a candle closure disrespecting it. The buy side imbalance, sell side inefficiency is basically a bullish fair value gap where you'll be buying from. And a sell side imbalance, buy side inefficiency is the exact same thing, except it's just a bearish fair value gap. Now you don't need to call them these. I just learnt these. It's just a very posh way of saying fair value gap. It's not needed, but if you want to call them that, then you can. Now we've got our intermediate term low, which is a low inside of a fair value gap, and our intermediate term high, which is a high inside of a fair value gap. So the way that I have come so far so fast with trading is by watching videos like these, taking down loads of notes and going straight to the markets after watching the videos and trying to find what I have just learned. So I'd advise you guys do the same. It really nails it into your head. And yeah, so that's going to be everything for today's video on fair value gaps. It may have been quite a short one because this is a very easy concept to understand. However, this concept, once you've learnt it, can take you a long way. I use these every single day in my trading, and it has helped me become very successful in trading. So yeah, I hope you enjoyed this video. I hope that it helped you learn some things, and my next video is going to be going over equilibrium, and it's going to be covering how I use fair value gaps with equilibrium and how I use liquidity with equilibrium. So it's going to be going over the 2 videos that I've already done, as well as a new concept. So yeah, that's going to be all for this video today.